Ladies and gentlemen, you must have heard recently about the Indian market regulator, Securities and Exchange Board of India (SEBI), banning the New York-based firm Jane Street from the securities market for allegedly manipulating the bank nifty using derivative positions, creating profits for itself and losses for the retail investors on the other side of the trade. In an interim order dated the 3rd of July 2025, SEBI impounded rupees 4,843 crores plus worth of amount, that is around 570 million US dollars, and directed the entities of Jane Street to open an escrow account and deposit the money there with a lien marked in favor of SEBI. Further, SEBI put a restraint on the entities of Jane Street from accessing the securities market and prohibiting them from buying, selling, or otherwise dealing in securities directly or indirectly. A lot of restrictions have been put on the bank accounts of Jane Street entities, which can only be operated now under strict supervision by SEBI. Further, the order mentions that the entities shall not dispose or alienate any of their assets or properties in India till such time the amount of unlawful gains is credited to the escrow account. The entities are further directed to provide a full inventory of their movable and immovable assets in India within 15 days of the date of the order, which is the 3rd of July 2025. Phew, reminds you of the movie Wall Street, doesn't it? Where the SEC comes after the legendary trader Gordon Gekko. Greed is good, that's what he said. Looks like SEBI has got Jane Street by the jugular this time. Now, let's first understand a little bit more about the firm called Jane Street. The Jane Street Group LLC is a global proprietary trading firm in the financial services industry. It was established in the year 2000. It employs more than 2,600 people in 5 offices across United States, Europe, and Asia, and trades in 45 countries no less. In India, the 4 entities of the Jane Street are as follows. It is to be noted that while the last 2 are registered as foreign portfolio investors or FPIs in India from Singapore and Hong Kong, the first 2 are not the FPIs and are like any other Indian entities. Now, the interim order by SEBI did not come all of a sudden. There has been a lot of investigation done by SEBI over a year to gather evidence. Let's see how it all started. It all started when a media report caught SEBI's attention in April 2024. That media report mentioned that Jane Street had sued a rival firm called Millennium Management in the United States. It seems that 2 of the Jane Street's former traders had stolen its proprietary trading strategy before joining Millennium. Jane Street claimed that this strategy had helped generate nearly $1 billion in profits when used in India's derivative market in 2023. When SEBI sleuths read this report, their ears perked up. Strategy? What strategy? And they said, let's find out. And that's what SEBI did. On July 23, 2024, SEBI asked the National Stock Exchange NSE to examine the trading activity of Jane Street to ascertain if there was any market abuse involved. In August 2024, SEBI interacted with Jane Street and Jane Street provided its written submission on the 30th of August 2024 explaining their trades. So now Jane Street knew that they were under the scanner. On the October 1st, 2024, SEBI issued a circular announcing a series of policy steps in order to address what was seen as overtrading in index options on expiry day. SEBI was clearly worried that while the retail participation in index options trading on expiry day had moderated somewhat in recent times, around 90% of them continued to lose money. On November 13th, 2024, NSE submitted its examination report on Jane Street's trading activity to SEBI. In December 2024, SEBI observed, presumably based on NSE report, what appeared to be abnormally high or low volatility on weekly index option expiry days. Further, SEBI noted that there were certain entities consistently running what appeared to be by far the largest risks in cash equivalent terms in futures and options, particularly on expiry days. And thus, SEBI constituted a team for a detailed and comprehensive analysis. On February 4th, 2025, SEBI team of officials noted that prima facie, Jane Street Group appeared to be engaging in activities in violation of SEBI PFUTP regulations. PFUTP stands for Prohibition of Fraudulent and Unfair Trade Practices relating to the securities market. SEBI lost no time, and on February 6th, 2025, while the detailed examination was ongoing, but with a view to ensure that JS or the Jane Street Group desisted from undertaking trading patterns that were prima facie fraudulent and manipulative according to SEBI, on SEBI's instructions, NSE as a first line regulator issued a caution letter to Jane Street Singapore and its related entity GSI Investments, advising them to refrain from taking large cash equivalent positions and to refrain from undertaking certain trading patterns. Jane Street replied to the caution letters in February of 2025 itself. On May 15th, 2025, SEBI observed that in disregard of the caution letter from NSE issued in February 2025 and JS Group's own commitments to the exchange, Jane Street Group was observed to continue to run very large cash equivalent positions in index options. SEBI then gathered all the evidence and slapped the interim order on the 3rd of July 2025 on Jane Street, freezing its trading activities and impounding the profits obtained from the alleged manipulation of the bank nifty. So now let's jump into what were the strategies used by Jane Street allegedly to game the market via bank nifty. But before we do that, let's quickly understand some basic concepts which will help us understand the whole game played in the market by Jane Street. So the first concept is the cash market segment, and that's really the easiest. We have our usual Alice and Bob. There's a company called XYZ whose shares current market price is rupees 100. Alice wants to buy one share of XYZ. Bob wants to sell that share. Alice gives the rupees 100 to Bob. Bob gives the share to Alice. This is called the cash market. We all understand that this intuitively, nothing complex about it. Now let's go to the derivatives market. The first derivative is called futures. So again, the current market price of XYZ is rupees 100. Here, Alice and Bob agree that say after 1 month, Alice agrees to buy the share of XYZ at rupees 120 and Bob agrees to sell the share at 120. Thus they enter into a futures contract. If the price of XYZ after 1 month is rupees 150, then Alice is happy because she can buy the share from Bob at 120 and sell it in the market for 150, making rupees 30 in profit. If, however, after 1 month, if the price of the share is 90, then Bob is happy because he can buy the share from the market at 90 and sell it to Alice at agreed future price of 120, making rupees 30 as a profit. Usually, the futures contract is settled in cash with Alice or Bob getting the above money into their accounts instead of transacting any share. Alice and Bob have to typically reserve some money called margin money with the broker, say in our example rupees 20 to begin with, to avoid the risk of their default. The margin requirement may increase for a party if the current market price of the share moves against their position. The second instrument in derivatives market is called options. So again, the current market price of XYZ is rupees 100. Here Alice sells a call option for rupees 1 to Bob at a strike price of rupees 120 for 1 month later. This means that Alice gives the option to Bob to buy the share of XYZ for rupees 120 from her, and Bob pays to Alice for buying this option, that is rupees 1. Now, after 1 month, if the price of XYZ is 150, then this is hooray for Bob because he can buy the XYZ share from Alice at 120, can sell it in the market for rupees 150 and profit rupees 30, which comes from Alice. But hang on, he did pay rupees 1 to Alice earlier, didn't he, to buy the option. So his actual profit is not rupees 30, but rupees 29 academically. But after 1 month, if the price of XYZ is 90, then it's hooray for Alice and no good for Bob to exercise the option of buying from Alice at a price of 120 because he can buy it cheaper from the market instead at rupees 90. So he throws his option into the dustbin and lets it expire, which is completely okay. It is now hooray for Alice because she sold the option for rupees 1, which has now expired worthless for Bob, and thus Alice gains rupees 1 here. Imagine if she sold 100 such options because she somehow knew that the price of XYZ would go below 120, then she would make rupees 100 as a whole. Likewise, we have the so-called put options. So again, the current market price of XYZ is rupees 100. Here Alice sells a put option for rupees 1 to Bob at a strike price of rupees 120 for 1 month later. This means that Alice gives the option to Bob to sell the share to her for rupees 120 and Bob pays to Alice for buying this option, that is rupees 1. Now after 1 month, if the price of XYZ is 90, then this is hooray for Bob because he can sell the XYZ share to Alice at 120 by buying it from the market at 90, making rupees 30 as profit, which comes from Alice. But hang on, he did pay rupees 1 like earlier to Alice earlier to buy the option, so his actual profit is not rupees 30 but rupees 29. But you get the idea. But after 1 month, if the price of XYZ is 150, then it is no good for Bob to exercise the option of selling to Alice at a price of 120 because he can sell in the market for rupees 150. So he throws his option into the dustbin and lets it expire, which is okay. It is now hooray for Alice because she sold the option for rupees 1, which is expired worthless for Bob now, and thus Alice gains rupees 1 here. Imagine if she sold 100 such options because she somehow knew that the price of XYZ would go above 120, then she would make rupees 100 as a whole. Now there are two important things to take home from all this. One, you can play for far more number of shares using derivatives, that is futures and options, than the cash market for the same amount of capital. In our examples earlier, Alice or Bob had to stake rupees 100 for playing with 1 share of XYZ in the cash segment. But in the futures section, since the margin requirement for 1 future was rupees 20 per share, so Alice or Bob could take a position for 5 shares with rupees 100 capital. So you see, this amplifies their game 5 times than the cash market segment. In the options segment, Alice and Bob had to just play with rupees 1 for a single share per option in my example, so they could now take a position for 100 shares with rupees 100 capital. So you see, this amplifies their game 100 times than the cash or the spot market segment. Cool, isn't it? If Alice could manipulate the price of the company XYZ somehow magically in her favor using cash and future markets, then her investments in options would earn her a fortune due to the amplification explained earlier. Even if she loses some money in trying to manipulate the prices, she could, on the balance, win much more in options. And that's what Jane Street allegedly did. Imagine Jane Street as Alice and the rest of the market consisting of other players, including the small retail players such as Bob. Alice kept on winning and Bob kept on losing. The company XYZ of our example was a bank nifty, which is an index comprising of the most liquid and large capitalized Indian banking stocks. The index has 12 stocks from the banking sector. The top stocks of the index include HDFC Bank, ICICI Bank, Axis Bank, Kotak Mahindra Bank, and the State Bank of India. Now let's see how exactly the game was played by Jane Street, because now we have the basics of the game with us. According to SEBI, Jane Street used 2 strategies for winning money. The first strategy is what SEBI calls in its interim order as intraday index manipulation strategy. I repeat, intraday index manipulation strategy. Here, Jane Street allegedly pumped up the prices of the Bank Nifty by buying Bank Nifty very aggressively using its funds in the cash and future segment in the first half of the market hours. Simultaneously, it took large positions in options towards bearish side by buying cheap put options and selling expensive call options, which is essentially a bet on the prices going down or being bearish. But this doesn't make sense, does it? On the one hand, Jane Street is buying Bank Nifty and that is going to take the prices up. So why is it taking positions in options which will profit only if the Bank Nifty goes down? And that is really the name of the game. If the prices went up, Jane Street would find enough counterparties to play with the options from the players who would think that the prices are going up in the first half of the day because those counterparties get a bullish feeling. They would be willing to take positions in options against Jane Street, thinking that the price is going to continuously rise without knowing that Jane Street is the one making it rise in the first half of the day. In fact, as per observations by SEBI, on one of the days, as an example, Jane Street's short positions in options became around 7.3 times their long position in the cash and the future segment. Now, in the second half of the day, when the price is at its peak and Jane Street has taken the positions in options on the bearish side, they start selling the Bank Nifty aggressively in cash and futures, so much so that the price falls rapidly and, in fact, falls so aggressively that Jane Street actually books losses in the cash and future segment because its buying price was higher than the selling price. But the profits in the options now more than compensate for the losses in cash and future segment. Good day's work, Jane Street. Cheers to you. Money for nothing and the chicks for free, as sung by Dire Straits. Well played by Jane Street, while the counterparties have their shirts taken off their backs. Now let's look at the second strategy from Jane Street, which is called by SEBI as extended marking the close strategy. I repeat, extended marking the close strategy. Here, Jane Street begins by low volume, non-directional or passive trading in all segments from 9:15 a.m. till 2:30 p.m. That is 1 hour from the close of the markets. In the last 1 hour, Jane Street aggressively accumulates its position in the options segment. And simultaneously, Jane Street does aggressive buying in cash and futures if its position in options segment was in favor of Bank Nifty price rise, or does aggressive selling in cash and futures if its position in option segment was in favor of the Bank Nifty price going down. Thus, the Bank Nifty index closes at a price level favorable for the large option positions of Jane Street in Bank Nifty options. And post-market, Jane Street books profits in the index options. In fact, SEBI tutors us all, explaining in its interim order that, quote, extended marking the close refers to a manipulative trading practice where an entity aggressively places large buy or sell orders in the final moments of a trading session with the specific intent of influencing the closing price of a security or index to its advantage. The practice is particularly concerning on derivative expiry days as the closing prices directly affect the settlement value of the index-based contracts, thereby impacting payoffs for all the market participants. Unquote. So once again, well played Jane Street. You placed a big bet on the last ball 6 and made the bowler bowl you a full toss on the last ball, to give you an analogy from cricket. Now then, Jane Street is really an FPI or a foreign portfolio investor. And according to SEBI regulations for the FPIs are prohibited from netting of trades in cash market, which essentially means they cannot sell shares before they are credited to their demat accounts or perform simultaneous buy and sell trades within the same day. But there is no restriction on taking positions in options. So how did Jane Street manipulate the price of Bank Nifty in the market with large buying or selling in cash segment? It turns out that GSI Investments Private Limited, the JS Group entity incorporated in India, and thus it does not become a foreign portfolio investor FPI, executed intraday trades in cash segment. The two FPIs forming part of the Jane Street Group took large positions in the options segment, which was not prohibited by SEBI regulations for the FPIs. Thus, the intraday cash market transactions undertaken by the Indian entity consistently ended with large losses, while the true FPI entities made huge profits via options. So it appears that the incorporation of the company in India enabled the Jane Street Group to get around the regulator's prohibition against cash market transactions, which solely applied to the foreign portfolio investors or the FPIs. The FPIs, with their options positions, made the profit. SEBI also notes that FPIs are free to repatriate their profits and exit Indian markets at their discretion. Pretty nicely done by the lawyers of Jane Street, I suppose. What is disturbing is that SEBI mentions in its interim order that it wrote to Jane Street warning them of their market actions and asked them to not perform these actions. As for example, one of SEBI's letters to Jane Street on February 6, 2025, the letter from SEBI to Jane Street mentions, amongst other things, quote, the above trading activity prima facie appears to be fraudulent and manipulative in terms of dealing in top constituents of index in cash and future segment and taking large size contra position and options expiring on that day on the same index. In this connection, it is advised to exercise caution and refrain from taking large open positions. It is further advised to refrain from aforementioned trading pattern and unwind such positions in a non-disruptive manner and report on a daily basis to us till further notice, unquote. That itself should have sent shivers down the spine of Jane Street. However, SEBI notices that despite the said letter, JS Group was seen to be running very large net cash equivalent positions in index options. Disturbingly, on days such as May 15, 2025, which was an expiry day for Nifty weekly options, JS Group was seen not only running very large effective cash equivalent long positions via Nifty index options, it was also seen to be intervening heavily in Nifty futures and Nifty constituent stock futures at close to the expiry. So what happens now? Jane Street has 21 days to respond to the interim order from the date of the order, that is 3rd of July 2025. SEBI is ready for a personal hearing too. Of course, Jane Street can appeal at the Securities and Appellate Tribunal SAT, where it might want to get a stay on the order, and then the hearings could go on for years. Later the case could go to the Supreme Court too. At the moment, it is a big blow to Jane Street since its trading is completely halted and its bank accounts are nearly frozen except for limited transactions under the supervision of SEBI. I must say that SEBI officers have worked very hard and produced solid evidence of the trades done by Jane Street and their analysis to prove that the attempt was there to manipulate the markets. There are detailed graphs and tables, and kudos to SEBI for that. Jane Street will have to work equally hard to counter all that with their own data. My heart goes out to the judges who will eventually have to pass a verdict with all this data around, presumably at the SAT or at the Supreme Court. It'll be a lot of effort spent for sure, and the lawyers will surely make a lot of money, so congratulations to them. However, let's examine if what Jane Street did was really illegal. Of course, SEBI has cited various sections of the law in its order and the precedent court cases to claim that what Jane Street did is fraudulent and is market manipulation. But it also begs the question, why do you let big players in the market lose who can really move and manipulate the market should they choose to? And if you allow such players, why don't you put hard restrictions so that they cannot take large positions beyond a particular value? Unless this is done, it would happen again with some other institutional player. Today, Jane Street has been caught partly because its secret strategy was spilt in its lawsuit with Millennium, and the media reports came into open and SEBI latched onto that. What about the other big players who might be following similar or other strategies to manipulate the market, perhaps not in Bank Nifty, but other indices, and have not been caught by SEBI yet? Should the retail investors be completely banned from the futures and options segment, which were famously called as the financial weapons of mass destruction by Warren Buffett? Asking a player in the market to not do trading in a particular fashion is akin to saying to a player in cricket not to bowl fast, or not to spin the ball, or not to hit a six. Trading is an art and a science. Nobody is asking the counterparties in trading to willingly walk into the traps laid by a particular trader. You trade at your own risk. If the other traders are foolish and naive, it is not the fault of the trader laying the trap or using a strategy. So SEBI should allow free trading and let the market bear the consequences and learn from it. Or completely disallow by making it impossible for entities to take large positions, and disallow it via the software used to control and observe the market positions. Otherwise, this will happen again and again, probably is already happening and nobody is aware of those cases. Let's now see how the SEBI versus Jane Street case unfolds in the coming months. For the moment, this is Prashant signing off.